All right, we'll now move on to your next slide for the topic of corporate financial markets. Now we'll look at what are financial institutions, types of financial institutions, and roles of financial institutions in PNG market and the financial markets in PNG. All right, what is a financial institution? You will see that the financial institution in PNG, it's any natural legal person who conducts as a business one or more of the following activities. All right, they accept deposits and other repayable funds from the public, lending, financial leasing, money or value transfer services, issue and managing means of payment, financial guarantees and commitments, trading in money market, foreign exchange principal securities, participation in security issues, and individual collective portfolio participation in security issues. I'm going to a slides that is titled financial institutions. All right, what is a financial institution? FI, so financial institutions, is an organization engaged in the business services dealing with financial and monetary transactions such as deposits, loans, investments, and currency exchange. All right, financial institutions is a company that deals with money as a bank, savings and loans, or credit union. So let's see the place of an economy without financial institutions. So without financial institutions, you will see that households, savers and suppliers of funds have cash that they give to corporation, borrowers of funds, and as a result, the corporations exchange equity and debt. So an example of it is funds flow between households and corporations are cash, equity, and debt. The level of fund flows between households and corporations is costly. Why? The three cost-facing issues that affect corporate securities: the monitoring cost, the cost relating to monitoring how the fund is doing and whether the firm's corporations use the funds properly; the liquidity cost, the cost related to the ease of converting a security into cash. You must have liquidity if you're gonna take on deposits or lend out money and stuff like that. And the other thing is the price cost, the risk that sale price of a security will be lower than the purchase price of that security. So as a net result, when there are absence of financial institutions in the market, you will see that it's an imperfect allocation of resources in the economy. So when you have a financial institution in the market, you will see that households, suppliers of funds, they go to financial institutions, then corporation uses borrows of funds, and then equity and debt, deposit and other claims. So funds flowing between households and corporations are higher. FI is a sort of intermediary between households and corporations, and you will see that they sort of provide a balance in the system there. All right, there are two functions that financial institutions serve. They serve a brokerage function, and then they serve an asset transformation function. So a brokerage function, you would see that they act as an agent or broker for their customers, and then they provide advisory and financial services for commission or fees. All right, FIs can carry out investment research and make investment. They can buy, sell securities at a better price with greater efficiency. Brokerage functions helps reduce costs, transactions costs or market imperfections with households and corporations. The other function that they have is the asset transformation function.